Good morning and welcome back to Market Monday. You may notice a new face with me today. It's my pleasure to introduce Ben Sullivan, a fairly new member of our team. Ben is helping out with portfolio trading and rebalancing, financial planning, input and maintenance, and meeting preparation. If you haven't interacted with him yet, please expect to do so in the future. Please hold him to a high standard and view him as an extension of Chad or myself. Did I set the bar low enough?
Yeah, I think so.
Well, something we talk a lot about in the office is, of course, the market gyrations, the news flow, narratives, as we often talk about, and one part of that is memes. We all know memes, right? But before we dismiss memes as just silly cartoons, let's tease that apart a little bit and see if there actually is any value beyond the cursory entertainment component.
We actually first start to see the word meme show up in the 1970s as a unit of culture. But we can take it back a lot further to the Greeks, whose mimesis basically meant to mimic or imitate how works of art, literature, or plays mimicked the real world. Here we are in the 21st century, and while internet meme culture has taken a life of its own, we do feel it can still be helpful in understanding culture and sentiment, especially as irrational as markets can be.
Before we dismiss culture as something that should be kept in the philosophy books, I'm sure there's no one watching this video who dresses up in orange and blue on Saturdays and does this with their hands. I may do this, but of course you wouldn't hold that against me, would you? Some people may wave white streamers, even wear cheese blocks on their heads because they happen to live close to that team. Culture, units of culture, likely influence us more than we're consciously aware of.
When we apply memes or units of culture to investing, we like to zoom way out to assess its impact on markets. We really view it as happening in two stages. First, starting with the passage of the Pension Protection Act in 2006. The PPA put 401k plans on a trajectory by number one, allowing companies to automatically enroll new participants instead of an employee having to request enrollment, call the company, fill the paperwork, choose investments and beneficiaries. Now they would have to opt out if their employer chose automatic enrollment. And that has only gained steam since.
So now you've got millions and millions more people participating in 401ks. The money they're contributing has to go somewhere, right? For the next couple of years, that default investment option was often a money market type fund, a capital preservation fund. Then around 2012, the Department of Labor, DOL, offers more guidance relating to that default fund, which leans more and more to target date funds. And in 2015, the retirement plan for federal government employees, the Thrift Savings Plan, switches their default investment to a target date fund.
Target date funds, very simply, are a predetermined asset allocation based on your age. The younger you are, the more stocks you will have. The closer to retirement age you are, the more conservative or more bonds you will have. And it automatically adjusts and rebalances over time. So now you have not just millions more people participating in 401ks, now you have billions upon billions more dollars pouring into the stock and bond markets via target date funds. So here we are in 2014, under $1 trillion of assets in target date funds. To last year, over $3 trillion with a T in target date funds.
Add to that the COVID lockdowns that spurred an entire new generation of stock market investors, or should we say speculators. Take a look.
You buying the dip?
Birthday girl.
Yeah.
Yeah, birthday girl.
Buy the dip if you have the chip.
Buy the dip if you have the chip. Buy the stock market dip if you have the funds to do so. And again, before we dismiss these young ladies as just a silly internet meme, do you think this would have happened even 10 years ago? How about 30 or 40 or 80 years ago? Stock investing Buying the dip is now ingrained even in youth culture. Add to that the warp speed that information travels nowadays, and you get a much different market today than in decades before. So a few months ago, when everybody was calling for a recession or capitulation, or for the small retail investor to sell at the bottom, or for this or that to happen, because that's what happened before, we want to step back and at least give proper respect to how culture influences markets at scale.
And we certainly don't dismiss market history. That's all we have to go on. But we don't expect history to precisely map onto current markets. With everyone debating whether this recent rally is in fact a new bull market or just another bear market rally, we wanted to put some evidence to it to inform our thinking. Let's start with this year for context. We dropped 9%, then bounced back 6%, then dropped again, and in March, bounced 11%. A couple more fits and starts, and this current rally is now over 17% from the bottom.
Here's 0809. Deeper drawdowns for sure. Here, about halfway through the full drawdown in terms of time, we were at about a 22% drawdown, which is just a touch less than the full drawdown we experienced this year. And we have some 7s, a 12% bear market rally. Then as the drawdown got deeper, we had 18.5 and a 24% bear market rally before the ultimate end was in.
And for good measure, here's the 2000 to 2002 bear market. You can see we started with 7s and 8s and quickly got to 19, 21, 20, and another 20% bear market rally. So one feature to keep in mind is that the deeper the drawdown became, the higher the bear market bounce. That's the evidence of prior bear markets. Again, should we really be comparing this year to 08-09 and the dot-com crash? We don't think they are the same animal, but we always have to consider the evidence.
All right, on our way out, please enjoy some of our favorite memes from this year. Have a great week.